With stocks sitting near their all-time highs, the big questions investors are asking is which parts of the market are still cheap and which are too expensive. Dominic Chu did some digging and has the breakdown.
The stock market appears to be showing at least some positive short-term signs of momentum as we head towards the heart of corporate earnings season. Major stocks indices sit right now just a few percentage points away from record highs, but the market's march back towards those levels have left some investors wondering if things have gone a little too far too fast. One of the hottest sectors of 2016 in the S&P 500 has been the utilities. The sector overall has gained around 12% year to date, and a big reason behind it has been the hunt for dividend-paying stocks. As a result, the sector is more expensive than it's been on average over the past 15 years.
If you look at utilities, for example, on a historical basis, that's very overvalued, but the same would apply to the bond market. If you're assuming that you're going to get these returns based on the dividends and based on the yield, and rates go up, which they're likely to do, that valuation becomes much more a question.
Some experts are looking to other parts of the market with more perhaps attractive valuations that have been beaten up as of late. Energy stocks seem to fit the bill for some of those brave enough to weather oil price volatility.
Right now, no growth at all essentially is priced in. And we are going to see that probably towards the back end of the year, but certainly in the out years. So that's an area that on an absolute basis also looks undervalued with respect to future opportunities.
One of the big bullish arguments for the rest of the year hinges on whether we can see some more strength in corporate profits. They're not expected to look good for the first quarter of this year.
The expectations are so negative, positive surprises seem more likely than negative surprises. But I think the real issue is what does the rest of the year map out for? And if we get a better than expected season and they start to raise estimates, that could help the progress of the year a lot.
The S&P 500 is a little more expensive now than it has been on average for the past 15 years. So bears will point to a more stretched valuation. Now it comes down to whether earnings season can provide a positive catalyst for the markets. For Nightly Business Report, I'm Dominic Chu.